Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about United Rentals Inc. quarterly report. United Rentals offers a wide range of equipment rental services across two main segments, general rentals and specialty. General rentals segment rents general construction and industrial equipment such as backhoes, forklifts, earth-moving equipment, and material handling equipment, aerial work platforms like boom and scissor, lifts, general tools and light equipment including pressure washers, water pumps, and power tools. Specialty segment trench safety equipment, trench shields, shoring systems, etc., power and heating, ventilating and air conditioning equipment, portable generators, electrical distribution equipment, etc., fluid solutions equipment for fluid containment, transfer and treatment, surface protection, mats, mobile storage equipment, and modular office space. Additional services. Sales of new and used equipment through various channels, repair and maintenance services, parts sales for owned equipment, construction consumables, tools, small equipment, and safety supplies. The stock price of United Rentals, Inc. URI, has experienced a significant increase of 19.47% over the past year due to a combination of factors. Strong quarterly earnings and raised guidance have been a major contributor, with record-breaking results in Q4 2024, solid first-quarter performance in 2025, and strong second and third-quarter results. The company's strategic acquisitions, including the $4.8 billion acquisition of H&E Equipment Services, have also played a significant role in driving growth. Positive industry trends and market outlook have further contributed to the stock price increase. Ongoing infrastructure spending, particularly from the bipartisan infrastructure law, has fueled demand for equipment in projects related to roads, bridges, and other vital infrastructure. The company's specialty segment has demonstrated impressive growth, driven by expansion and new cold starts, which positively impacted revenue and margins. Additionally, a growing trend among construction companies to adopt asset-light, low-capital expenditure models has increased the demand for rental equipment. United Rentals' commitment to returning capital to shareholders through increased dividends and share repurchase programs has also signaled strong financial health and management confidence. Overall, these factors have combined to drive the stock price increase of 19.47% over the past year. The primary drivers of revenue growth or decline can be summarized into three main categories. On the growth side, the company has seen significant increases in equipment rentals and sales of new equipment, driven by strong demand from specialty segments such as infrastructure projects and industrial companies. Additionally, seasonal rental patterns have contributed to revenue growth. On the other hand, revenue decline is primarily attributed to decreased gross margins due to inflation and normal cost variability. Specifically, equipment rentals' gross margin has decreased by 200 basis points, while sales of rental equipment gross margin has declined by 240 basis points. The normalization of the used equipment market has also led to reduced margins in this segment. Overall, revenue growth is driven by strong demand for new equipment and seasonal rental patterns, while revenue decline is primarily due to decreased gross margins caused by inflation and normal cost variability. Net income and profit margins have experienced a decline in recent periods. Specifically, net income decreased by $7 million in Q3 2025 and $45 million year-to-date, YTD 2025. Profit margins also declined, from 41.3% to 39.4% in Q3 2025, and from 40.2% to 38.3% YTD 2025. The primary reasons for this decline are attributed to several factors. Firstly, the gain on sales of rental equipment decreased by $25 million. Additionally, depreciation and amortization increased by $162 million, contributing to the decrease in net income. Furthermore, a restructuring charge of $2 million also negatively impacted net income. Moreover, gross profit margins declined significantly, with a 190 basis point drop for Q3 2025 and a 180 basis point decline YTD 2025. This was largely due to a decrease in equipment rentals gross margin by 90 basis points Q3 and 1.7% YTD. These factors collectively contributed to the decline in net income and profit margins, highlighting areas for improvement in future periods. The company is generating a significant amount of positive operating cash flow, with net cash provided by operating activities reaching $3.934 billion in 2025 and $3.498 billion in 2024. This indicates that the company's operations are producing sufficient cash to cover its expenses, resulting in a positive cash flow. The company's debt level and interest expenses have remained relatively stable over the past period. While there are some minor fluctuations, such as an increase in total debt to $18,927 million and a slight rise in average month-end principal amount of debt outstanding from $1,918 to $989, these changes do not indicate any significant shift. Similarly, interest expenses have shown no substantial change, with a 4.3% increase over the 9 months ended September 30, 2025, being the only notable variation. Overall, there is no clear indication of a significant change in debt level or interest expenses. The company's segments and regions performed differently in terms of financial results. The general rentals segment showed mixed results, with strong performance in the Central Division, but poor performance in the Northeast and Southeast divisions. In contrast, the specialty segment performed well overall, driven by significant growth in equipment rentals and sales of new equipment in the United States and Canada. The key highlights from the specialty segment include a 15.2% year-over-year increase in equipment rentals and significant increases in sales of new equipment, with 23.4% and 29% year-over-year growth for 3 and 9 months, respectively. However, there is limited information on the performance of regions such as Europe, Australia, and New Zealand, suggesting that these areas may not be major contributors to the company's overall results. Overall, the specialty segment was a standout performer, while the general rentals segment struggled in certain divisions. Management's outlook and strategy, a focus on profitability and growth management, is cautiously optimistic about the company's outlook despite various risks and uncertainties. Their strategy focuses on driving profitability through revenue growth, margin expansion, and operational efficiencies. Key initiatives include providing superior customer service, optimizing fleet mix for profitable growth, and implementing lean management techniques. To achieve these goals, management plans to pursue strategic acquisitions, expand into adjacent markets, and improve financial flexibility through actions such as amending loan facilities. They also aim to optimize rental rates, time utilization, and mix to drive rental revenue through fleet productivity. In terms of funding, management expects existing sources of cash to be sufficient for the next 12 months, with plans to complete $1.9 billion in repurchases in 2025. They may seek additional financing as market conditions permit, but are currently in compliance with debt agreements. Overall, management's strategy is centered on driving profitability and growth while managing risks and uncertainties. The company has made 2 notable acquisitions. Firstly, the H&E acquisition was terminated, indicating that it did not proceed as planned. Secondly, a Yak acquisition took place, although the exact date is not specified in the provided summary. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company declared $1.79 per share for the 9 months ending September 30, 2025, with a total payout of $350 million. This is not an isolated incident, as the company has also engaged in share buybacks, repurchasing -1 million shares in 2025 and -2 million common shares in 2024. Concerns about inventory buildup and supply chain disruption are valid. The inability to obtain essential equipment and supplies from key suppliers due to insolvency or financial difficulties poses a significant risk. Furthermore, the potential for more severe disruptions in the future is a pressing concern. While sales of new equipment have increased due to supply chain normalization, this trend may be short-lived if supply chain issues persist. That concludes the financial summary for United Rentals Inc. Feel free to comment below, and I will be happy to answer them when possible.